Welcome back, everybody. We're here in studio with Kevin Dauphinee and the Gold Standard Retirement Podcast. Now, Kevin, the amount of information, particularly around investing or retirement planning, Social Security, taxes in retirement, etc. Speak to that a little bit about the vast amount of just either misinformation or misunderstanding of the information that's prevalent today.
Yes, as we were preparing for this podcast, one of the videos that I saw this past week, it just happened upon it, and it was a young man talking to an older investor, a very successful investor, and the young man, I would say he was in probably prime earning years, mid-40s, early 50s, and thinking that he would be able to withdraw money out of a tax-deferred account without paying tax on it. Well, that's a confusion of it's certainly doesn't hold true for the 401k, the IRA, 403b, 457, things like that. But it does. There are circumstances in the Roth IRA where that is possible, or Roth 401k as well. So these terms, it's a tossed salad of terms that are out there, and for people to try to keep all that straight is not easy. But the bottom line was misunderstanding about free withdrawals or tax-free withdrawals. And there is an opportunity to take penalty-free withdrawals after 59.5 from a tax-deferred account. So that's penalty-free. It's not tax penalty-free. So you get these sort of terms get jumbled together. So then if you're in a 401k or IRA, tax-deferred account, and you get past 59.5 and you want to take money out, that is reported as ordinary income and goes on the 1040 as such. So those kinds of things are, there's some misunderstandings that occur, and that's what we're here for. And I think any advisor worth their salt will offer a prospect that is essentially qualified for that business to offer consultation at no obligation, just say have a conversation. So what does that do for the advisor? Is the advisor wasting their time? No. If the advisor impresses on the prospect that they have something to offer that prospect, then there may be a further engagement and ultimately becoming a possible client. So it's the barriers between advisors and prospects is fear. We're still suffering from the Bernie Madoff hangover. And I also believe in the 80-20 rule. I think there are 20% of advisors out there that are absolutely top-drawer professional, and 80% of them are just so-so. So how do you, as an investor, find the 1 out of 5 that's worth your time and trust to have that person provide guidance for you through the rest of your life to make sure that your money doesn't run out?
Yeah, how would they do that?
Well, it's difficult. I mean, it's you can go to the websites. I mean, you can go to the Certified Financial Planner, and I met some certified financial planners that I wouldn't do business with. And that's not to say that certified financial planners don't have exhaustive information, but if you've been in the business for 5 years and you pay attention, you probably have a pretty good idea. Now, a certified financial planner that does tax, there's a handful. That's less than 0.001% that's CPA and CFP. So that's a rare bird. Now, the CFP also is supposed to have substantial knowledge about trust planning and estate planning. Well, we just leave that to estate planning experts, to attorneys. So I believe in staying in your lane, focusing on the stuff that you know, and doing that. So that's the way that we position ourselves. We have tax practice within Gold Standard CPA, Gold Standard Financial Services. So the point is, don't be afraid to have a conversation. Talk is cheap, you know that. So and ask the questions, and a little bit of guidance for somebody that's looking for a financial advisor. How much time are you speaking in that meeting compared with the advisor? If you're not speaking at least 2 times what the advisor is speaking, you're in the wrong office. Because you don't need to know how smart or lettered that advisor is. The advisor needs to know what you want to do with your money in your life.
Yeah, they need to know what that particular investor or retiree's situation is.
Exactly, yeah.
And unfortunately, I think that a lot of the retirees are consuming that information and assuming that it does apply to them, when in fact it might not. It might not quite be the case, or the opposite, where they might think that it's not applicable to them, when in fact it actually could be a strategy that could totally change their retirement planning for good.
Sure. I think over the years in my time in this business, I've learned that one size fits one, and we absolutely will not apply a template to anyone. When we collect documents and analyze the data, there's no two that are even close to being alike. Even if the numbers might be comparable and in the similar categories because their ages might be different or their aspirations might be different, the calculations that we perform are always different. It's easy to get on the internet and find something that's attractive, and it's like changing the channels on TV and you find something you want to stay on. And sometimes the information is just not at all suitable for that individual or family or even business. Yeah. So, yeah, we're real cautious about the amount of references, referrals that we provide to clients and say, why don't you take a look at this? There's a lot of folks out there. There's one retired advisor, really smart guy, and he's absolutely accurate. But again, he's accurate for a segment of the investing community. And he said, well, you can invest in, say, the Vanguard S&P 500 Exchange Traded Fund, ETF, and the fee to have your money in that account is 0.03%. That's incredibly low. Now, if you're 30 or 40 years old and you want to invest in that in whatever account you want for a long time, for say 10, 20, even 30 years, you're going to be just fine because the S&P averages about 7% a year over the last 90 years. So just play the averages. If you're 65, you don't have all that much time. If you're 75, you have that much less time. So those are the kinds of things that when you hear those things of, self-directed investing in an index and set and forget, that holds true for my sons certainly in their 40s, but not for someone in retirement.
Yeah. You've certainly seen a lot of people come into your office, and you've had some that have come in with an assumption that maybe was less than accurate.
Yeah, there's a gentleman, really, really smart guy, and we went through a lot of planning and analysis of his data, and he's pretty well set for life. And he's not going to live in a McMansion, but he and his wife could cross the finish line with grace. There was no question about their total wealth. When I made a proposal for a particular safe money annuity, the response was, well, we're too young for it to buy an annuity. Well, I don't know where it says that you have to be of a certain age to invest in an annuity. We think that it all depends on the individual, the family, and all the data. So let's say if you got $2 million, and it's all in the market, and it's all in 401k and IRA and all that stuff. Well, let's just assume that it's a $50,000 expense budget to maintain the lifestyle, and that's it. There's no more, and there's Social Security, but there's no more earning potential. They're fully retired. So we can fashion out of that $1 million very easily, placing it into a moderate growth portfolio that will provide income to give a $50,000 a year income for that family, but take some of the risk off the table. And that's what we put into the annuity. Now, annuities, by and large, it's a rule of thumb. Fixed index annuities will appreciate at about 7+% over 10 years on average. So not every year is going to be 7. One might be 12, and one might be 2, and you might get a 0 in there. But time after time after time looking at illustrations, you double your money in 10 years. So that certainly beats inflation, and it's safe. You're not going to lose anything. You'll always get the return of that premium if there's a cataclysm. We don't think that's going to happen anytime soon. So for that particular gentleman, it's not too early for him to invest in a safe money annuity. Variable annuity, absolutely not. Probably it depends what your thoughts are on fixed annuities. We don't do many of them. Sometimes for older clients, we do that because of the income potential. But that's one case. Another interesting case was a very high net worth client spoke to me about Roth conversion, a lot of money in their qualified accounts, and 70 years old. So there's enough runway to do a Roth conversion over, say, 10 to 12 years. And when I did the calculation, the benefit was literally in the millions, multiple millions, not one, couple plus, that this Roth conversion would create. Now, granted, you have to pay tax along the way. It's ordinary income tax, and you're going to bite the bullet, write a check, and it's done. However, what goes into that Roth IRA, once you get to the fifth year in the establishment of that Roth IRA, all of the appreciation, including further contributions into that, are tax-free appreciation for life. Plus, you have the flexibility of being able to withdraw on demand because you already paid tax on it, so there's no penalty. So the Roth IRA is one of the most valuable entities for an investor and especially a retiree. And this particular person thought that they thought they were too old to do a Roth IRA. Well, if you look at the arc of their life, and our planning goes out to age 95, so from 70 to 95, 25 years, we can get all of that IRA money converted in 12 years. Now, granted, we're having a tax increase in 2026. So anyway, if you do the math, and based on current tax law, it could be worse in the future. Well, that conversion may have cost some, I want to say, couple of hundred, maybe $300,000 in current tax money in the conversion, but the end benefit would be multiple millions to their net worth. Now, what kind of legacy is that? Their intention was to provide their beneficiaries would be two children, and those children would receive this money tax-free for 10 years. So they could, so for 10 years, double the money in 10 years. Let's say that they received $5 million each. They could turn that into $10 million. Granted, inflation, okay, all that stuff understood, very clearly understood. But that creation of generational wealth is quite a remarkable trick. And if you try to do it on your own, it can be done. If I can do it, just about anybody that's mathematically minded can do it. But to make sure that you're staying within the bounds of the law and minimizing the tax burden during the conversion, it's best left to a professional to do that. So the takeaways are, you're never too young for an annuity, and you're never too old for a Roth conversion.
Yeah, and what's interesting about the Roth conversion side of things is that people don't realize that as you get older, you're going to have RMDs anyways. And oftentimes, especially if you have a sizable qualified account into the millions of dollars, $2 million, your RMDs will ratchet up over time.
Absolutely.
Older you get, which will only increase your tax burden anyways.
Sure.
So why not reduce it now when it's at a lower rate to begin with? And with the notion that taxes are probably on discount today versus where they could be and where they have historically been over the last 100 years. They've historically been much higher.
Sure.
And so with that risk, President Biden's already talked about trying to increase taxes to the 44%, right?
Sure.
And so that people don't always understand, that's one of the areas of misinformation, is that they don't always understand that, by doing a Roth, there will be tax burden for sure. But by waiting later, you're going to pull it out in RMDs, and then you're forced. And when it does come out in an RMD, you can't do a Roth conversion on that RMD.
That's right. Yeah, of the reasons why I got in this business was I've been a troubleshooter, evangelist all my technical career, and I take complex concepts and break them down into bite-sized pieces. So when I left the broadcast business and got into financial services, the burden that's placed on seniors with all of the moving parts in the tax law is just it's unconscionable that Congress would place this burden on we, the people who pay their salary. And yeah, it's all in the finesse of juggling budgets and so forth. But I'm rather cynical about this. But 14 years ago when I got in the business, 59.5 was there was the over 50 contributions to you get the bump up in contributions to qualified accounts. 59.5 before or after. Before you get a penalty, after you don't get a penalty. Then there was the RMDs kicking in at 70.5. Now they're 73. All of those numbers were just really difficult for the client to understand, the taxpayer to understand. The notion of provisional income, how do you in tax the taxation of Social Security, calculating provisional income, 50% of your Social Security benefit is calculated as taxable income or provisional income rather. And if you get up to 44,000, which is just so little, if your provisional income is minimized, your Social Security will not be taxed. So, but it's so hard to do. It's threading a needle from 100 yards. It's really difficult.
Subscribe to hear more. We'll be coming out with a lot more information because there's a lot more things that need to be simplified.
Sure, yeah.
So thanks for tuning in today, you guys. We'll see you on the next episode.